Hi there, thanks for your time today. My name's Darryl Wilson from Affluence, and today I'm going to give you an update on the Affluence LIC Fund. So the LIC Fund is one of four we offer. You can see a snapshot of the medium and long-term performance there. Pleasingly, all of our funds have done pretty well over the minimum investment period of 3 years and longer. The exception to that is our newish fund, the Affluence Income Trust, which has just been going just over a year, but certainly had a pretty good start relative to our expectations. If you'd like to know more about any of the other funds, you're more than welcome to get in touch, or there's plenty of information on our website. So the LIC Fund, I'm going to give you a little bit of background and probably spend a bit of time explaining why now is a pretty good time to be having a look at it if you haven't already. The fund itself was set up in 2016, so it's been going just about 8.5 years now. We've got a pretty good track record, a long track record. We understand the sector very well, and we think we know when is a good time to be looking to add some exposure to listed investment companies. The fund is available for advisors on the Netwealth, Mason Stevenson, Hub24 platforms, and we're also looking to make that available on the super menus of each of those platforms as well. So if you do have any interest, please get in touch and let us know. Also importantly, for financial advisors, we've just received the inaugural research report from SQM, and we've got a very good rating there, 4-star superior high investment grade rating. And again, that report is available to financial advisors and wholesale investors, so please get in touch if you'd like a copy. I'm not going to spend a lot of time on explaining what LICs are. Hopefully you have a rough idea, but just very, very briefly, a listed investment company, or a LIC as it's known, generally is very similar to an unlisted fund and an ETF, with one key difference. So like those other structures, they're run by an external manager. They invest in generally stocks, but it could be bonds, property, all sorts of different investment strategies. The one key difference with LICs is that they invest or they trade at the whims of the market. So unlike an ETF, which you will always buy at the net asset value or at the value of the investments it owns, an LIC can trade well above and well below that. So when it's above that, we call it trading at a premium. When it's below the value of its investments, we call that a discount. And as well as the returns from the LICs themselves, it's the ability for these things to trade at premiums and discounts which excites us and which enables us to make additional money in this particular strategy. Now, there are about 85 LICs listed on ASX, and there's also a few REITs, which we also trade, and a few other discount capture opportunities that we look at from time to time. But the bulk of the investments in the LIC fund are LICs. We tend to have between 20 and 35 in the portfolio at any given time. And generally speaking, the more opportunities there are, the more excited we are about the sector, the more we're going to have in the portfolio. Now, to get into our LIC fund portfolio, you need to have three things. We're looking for three things. We're looking at LICs priced at abnormally large discounts, and that can be different for each LIC. Sometimes a small discount's enough because it normally trades at a premium. Other times a 30% discount isn't enough because we just don't have any faith in the ability of the manager or the strategy. So it is very different, and that's part of the trick here, is identifying what's a fair price for these things to trade at. Secondly, obviously we like to be buying value. We're value investors, and so where we can see that the underlying portfolio of investments that the LIC holds is particularly attractively priced, or where we have a very high conviction in the ability of the manager to outperform over the long term, that will also obviously get it into our portfolio. And thirdly, there are certain times, certain situations where we would add a short-term trade. So an example of that might be where an LIC is going to delist and turn into an unlisted managed fund structure, or some other form of restructure where that discount is going to be closed or eliminated. That's probably the least common holding in our portfolio. The vast majority of holdings either are discount capture or alpha opportunities, or in a lot of cases, both. Now, once we've identified the opportunity set, we construct a portfolio. We also take a top-down view. We run our risk management tools over it so that we don't have more exposure than we'd like to any particular sector, area, manager, individual LIC, and that ends up spitting out our portfolio of between 20 and 35 LICs. Performance, as I alluded to earlier, has been very, very good over the medium to long term. Distributions are paid quarterly, and they've averaged, in fact, between 7 and 8%, although we target a minimum of 5%. We've significantly outperformed the ASX 200 over 5 years and over. Shorter term, we've struggled. That itself is actually an opportunity. I'll explain why we've struggled and why that's an opportunity as we go through the next few slides. We've also been significantly less volatile than the market, which is an important factor if you're perhaps a more conservative investor. And obviously, we've given a pretty diversified portfolio at any given time. So a lot of investors in the LIC sector might only own 2 or 3, and they can tend to be quite similarly correlated. They'll move together quite a lot as markets move around. We tend to be able to provide a lot more diversification within our fund portfolio. There's 4 big reasons why we think it's worth looking at our LIC fund, and particularly now. Firstly, buy and hold is a difficult strategy in the listed investment company market. There really aren't too many that are going to outperform consistently, and discounts and premiums moving around can provide an extra complication for the sector if you don't monitor it very, very closely. So we've done very, very well against the entire field of LICs. The sector's pretty unloved at the moment. I'll talk about that and explain why and why that's an opportunity. But particularly now, the discounts are as big as they've been collectively at any time since we've been running this strategy over the last 8 or 9 years. We've currently got a big bias towards small company equities, ASX small caps, micro caps, and a little bit towards smaller resources as well. And the reason for that is there's a huge valuation divergence. We see a lot of the large cap universe as very overpriced. Small caps are in a lot of cases exceedingly cheap. I can't remember any time where we've seen that divergence to this degree in the last 10 or 15 years. It's very, very unusual, particularly when we're not in the midst of a bear market. So valuation-wise, we're able to tilt this towards a lot of LICs that are in that small to mid to micro cap space where there's really what we see as a huge amount of value to be had. And finally, the fund itself has been quite defensively, shown quite some defensive characteristics versus the ASX 200. It has tended to not fall as hard when markets fall. The converse of that is it's tended not to keep up when markets have gone ahead really, really strongly as they have in the last 12 months. So this is a 5-year chart of our Affluence LIC Fund, the red dot, versus all of the individual LICs, which are the blue dots that we monitor. There's about 60 or 70 that we monitor currently. And the black dot is the ASX 200. It's a bit of a complicated graph, but on the left-hand axis, you can see the returns. So we've delivered returns of about 12.5%. There aren't a lot of those LICs that have beaten us over 5 years. Very few have beaten us substantially, about 5. And then along the bottom axis, you can see the volatility or how violent the moves have been in the share prices and the unit prices. And you can see we've actually been less volatile than any individual LIC over that 5-year period. But more importantly, we've also been less volatile than all of the LICs that have outperformed us. And in some cases, they've been 2, 3, and 4 times as much volatility as our LIC fund. So on a risk-adjusted basis, this fund looks exceptional. The strategy looks very, very good. And we have managed to deliver returns about that 12.5% range over the last 5 years. So versus individual LICs, we look very good. The ones that have beaten us are mostly eclectic strategies, and they're ones where, whilst they've outperformed, they've also had periods of pretty decent underperformance, and you would have had to be pretty brave to have held on through that to get the full 5 years of performance. So versus even those, we think we're a pretty interesting play. Now, I mentioned earlier the sector's pretty unloved. This is probably the best example we can give you of how unloved LICs are at the moment. This is AFIC. AFIC is the largest LIC. It's several $1 billion worth of market cap. They've delivered returns over the last 10 years of just shy of the market, about 9.2% per annum versus 9.8% for the market. These are AFIC's own numbers. Over the last 3 years, 7.9% versus 9.5%, so slightly under the market. The interesting thing is if you look at the discounts and the premiums. So this is a chart of the discount or premium. So where this is a over 10-year period, where the numbers are above the line, above zero, this is a premium. So in this case, out in 2021 and into early 22, AFIC was trading at actually a 10 or 12, or in one case, a 15+% premium to the value of its investments. But you can see that over that last 3 years, it's moved to about a 10% discount. And so you've seen almost a 20% turnaround in the share price between a 10 or 12% premium and a 9 or 10% discount. Now, the reason that's important is because if you were a shareholder of AFIC over the last 3 years, even though the investment team has delivered almost an 8% underlying return from their investments, that's pretty much completely been wiped out by the share price going from a decent-sized premium to a decent-sized discount. In fact, if your total shareholder return over the last 3 years is about zero. And that's why it's important not only to understand what assets individual LICs own and how they're priced, but also what that discount or that premium is. If you bought 3 years ago, your return up until recently was about zero. But interestingly, if you buy it now at a 10% discount, what are the chances of that discount improving over the next 3 years? We would say, given the history of AFIC, we would argue there's a pretty good chance that that will improve, and that you will therefore, going forward, make some form of additional return from that discount closing, or even going back to that more traditional premium. So that's probably one example, the most obvious example of how unloved the sector is. And when we look across the sector, we see lots of stories just like this, where LICs individually are trading at or close to historical maximums in terms of the discount, which makes them particularly good buying on that basis. We do focus a lot on discount capture. We focus on being able to buy a LIC cheaper than it should be and to sell it when it gets more reasonably priced. And that strategy over the life of the fund has contributed about the same amount to returns as we've received from the LICs themselves. So if the average LIC, net of tax, net of costs, has delivered us around 6 or 7% per annum, we've also been able to achieve that same sort of return from moving around the sector as those discounts and premiums change. And that's a pretty significant source of additional income. Now, these are pre our fees and costs, but you can see that it's what makes the strategy particularly interesting is their ability to add value through that discount capture part of the strategy. And, it's not easy. It's okay to look at something like AFIC at the moment and say, well, that looks attractive. AFIC's actually not in our portfolio. And the reason it's not in our portfolio is even though the discount itself is attractive, we have some concerns about the large cap end of the market, and we believe that that's overpriced. So with AFIC, you might see a situation where the discount closes or even turns into a premium, but perhaps the portfolio itself doesn't go as well because the market's not going as well. And so a lot of our exposure is through LICs that have even greater discounts than that, but who have also a portfolio of assets we're much more excited about, whether that's small caps, private equity, or something else. We're generally finding a lot of LICs at the moment where we can see more than one way to make money. The important thing is we track all of this information. We track all of the publicly available information. in our own proprietary database, and that gives us, I wouldn't say a bit of an information advantage above the market, because all of the information we have is available to the market, but really no one else is correlating that information and using it the way we do to form that extra picture. So it does give us a bit of an advantage, we think, over the market in general, in that we've got an understanding of what a lot of these LICs own, how discounts and premiums have changed over time, and how perhaps an LIC might react in different types of market conditions. You can see here the discount on the portfolio. I mentioned it's at cyclical highs across our portfolio. It's currently 24 to 25%. And that's about a 10 or 11% greater than it was 3 years ago. So that's actually been a big headwind for us over the last 3 years, and it really explains all of the underperformance against the ASX 200 and more, but it puts us in a fantastic starting position. If we own a portfolio of LICs today, you can invest in that portfolio at a 25% discount. And that discount goes back to perhaps where it was 3 years ago at around 13, 14%. That's about 10% upside along the way, or 3 and a bit % a year, if you think of it in those terms. And if the portfolio went back to the sort of 7 to 9% level it was trading at back between 2016 and 2019, again, there's even more upside over and above that. So in terms of saying is now a good entry point, certainly in terms of that discount capture, I would say it's a very good time to be buying. Now, that doesn't mean it can't get worse, but historically, we really haven't seen it get much worse than this, outside of the very eye of the storm in the financial crisis. Even in COVID, it sort of bottomed out around 22, 23% and kind of started bouncing back from there. So from the discount point of view, extraordinary value in LICs at the moment, particularly in the portfolio that we've managed to put together. And obviously there's value in buying discounts. Now, there's two ways to think about that. Obviously, I've mentioned you can make money from those discounts closing, and therefore the share price moves up, even though the value of the assets may be the same. The second way to think about it is, even if those discounts never close, you know, even at a 20% discount, we're buying $1 worth of net assets for 80 cents. Okay, and there's embedded leverage on that. So if the manager of an LIC makes a 10% return on that dollar of assets, or 10 cents, that's actually a 12.5% return based on our buy price. So it's 10 cents on the $1 of NTA, but it's 12.5% return on the 80-cent share price that we've paid for it. And so the discounts are so great now collectively that, you know, even if the discounts don't close, there's a kind of a magnifier effect on earnings. So that's getting very attractive as well. Now, the second kind of timing issue I mentioned was the underperformance of small caps and the value that's kind of inherent in small caps. There's a bunch of graphs on this page, and it depends on what data you look at and sort of the market cap bands you're looking at. But in Australia here, if you look at the ASX 200 index versus various small cap indexes over the last 3 years, what you'll find is generally the level of underperformance by the smaller end of the market is somewhere between 20% and 35%. So in other words, small caps have underperformed large caps over the last 3 years by 20 to 35%. And generally the rule is the smaller you go, the greater the underperformance. So small and micro caps, we're now seeing some extraordinary value. We've got situations there where you can buy portfolios of value stocks at single-digit price earnings ratios versus, say, Commonwealth Bank at 25 or 26 PE at the moment. You can buy good growth companies at very, very good prices. And so there's just so much more value in that sector because it's really been ignored and it hasn't been re-rated. And so looking forward over a 2, 3, 4 year period, we can see a lot of upside in a lot of these small cap portfolios potentially. And so at the moment, a lot of the LICs we own are focused in this area of the market, focused on small caps, focused even in some cases on small resources where there's a tremendous amount of value as well. So there's a potential to make money in two ways. You can make money from discounts closing, you can make money from the portfolios themselves performing well above average. This gives you a bit of a snapshot of the current portfolio of LICs that we own in the LIC fund. We update this information every month. We put out a new report every month, which is always available on our website or via our monthly email. So you can see we've got LICs across a range of different sizes or market caps, but generally our sweet spot is between $50 million size and about $500 million size. These are LICs where we can trade in and out of as we need to. They tend to move around the most. They tend to move from discounts to premium the most, and they therefore create a lot more opportunity in that space. Geographically, all of the LICs we own obviously are traded on ASX, so they're Australian stocks, but a lot of them invest globally. So if you think of a Magellan or a Platinum LIC, they're obviously trading on the ASX, but they're investing in global stocks. And just over a third of the portfolio is currently ultimately invested in global stocks and about 58% within Australia. In terms of the discounts, we look at it in terms of different bands. By far the largest amount of our portfolio at the moment, almost 2/3 of the portfolio, is invested in LICs where the discount's at least 15% and about 30% where it's 5 to 15%. The vast majority of that 30% are closer to the 15% than the 5. So, that's how you get a kind of a 25%, 24% average discount. Some of these LICs are trading at 40, even 50% discounts to the value of their assets. So there is some extraordinary value here if things go well over the next 2 or 3 years. And you can also see, it's not all kind of long only equity LICs. There are also different asset classes. There are some REITs in there at the moment. There's some private equity. There's a little bit of debt-focused funds, although not much at this point. And even within the equity strategies, most of them are quite differentiated. So it's not your standard kind of long only benchmark hugging managers. A lot of these managers doing pretty interesting things in the space. I talked about perhaps outperforming on the downside, and this is something we focus on a little bit. So, equity markets can be volatile. Our fund is tended to be less volatile than the ASX 200, and the most obvious example here, this chart is the 10 worst months for the ASX 200 since we started the fund just over 8 years ago. In all 10 of those worst months for the ASX, our fund has performed less worse. So it doesn't mean it goes up when the market goes down, but it does mean it has tended to be much more resilient. And that's important because, the less you lose, the easier it is to get back to zero and start making money again. So we've tended to find that we've lost less, and that's allowed us to get that back quicker and be back into positive return mode quicker than the markets in general. If you're into stats, there's quite a few stats on this page, but that's ultimately what it boils down to, is that we've delivered returns that are better than the ASX over time, that have been less volatile than the ASX quite substantially, and that we've tended to do that in a way which means we go down less when the market goes down. We also go up a bit less when the market goes up strongly, as it has done in the last 12 months. That's kind of the price to pay, but overall, you're getting a better result down a less bumpy road. The fund pays quarterly distributions. We tend to target about 5% per annum, as I've mentioned previously. So we've done quite a bit better than that since inception. The way we look at that is we will tend to pay 5% per annum for the first 3 quarters of the year. And if we've had a good year in June, we might pay a higher distribution. But for most people, I would suggest you think about it as our return target is 5% per annum. And if we do better than that, it would be considered a bonus. Over and above that, we do pay franking credits. So like all managed funds, to the extent we get distributions or dividends, from unlisted LICs, from LICs, we collate all those and we pay them out once a year with the annual tax statement to investors. So all investors who get distributions from the fund will also get a share of the franking credits that we have to put in their tax return at the end of the year. Now, that can vary quite a lot. We don't specifically target income when we invest in LICs, so it can vary from year to year, but generally those franking credits have added somewhere between 0.5% and 1% to those annual returns, not included in any of our return numbers anywhere because it can be quite variable from year to year. Just to kind of finish off, maybe a couple of examples out of the current portfolio of a few LICs we like and why we like them. This is Ryder Capital. Ryder Capital is run by Peter Constable and David Bottomley. They're the key portfolio managers. It's been going for quite some years. It invests in mostly ASX small caps. It has a reasonably concentrated portfolio. It's reasonably small at about $100 million market cap. There's a few reasons we like it, and it is one of the larger positions. Firstly, we like the portfolio very much. It's a portfolio of small caps where we can see a lot of value and potential for increase in coming years. There's a strong alignment of interest. Peter and David not only own the investment manager, but they also have a lot of their own money invested in the LIC as well. So obviously they're incentivized to do well. The discount is just under 20%. And so you can see that this LIC has always traded at a discount, and apart from a very small period back in 2015. But as far as discounts go, it's close to those sort of maximums that it's been. So we would expect that there's going to be a lot of pressure on the team if it got much higher than that to look at doing something. And if that were the case, there's the potential for some sort of restructuring event, some sort of pressure from shareholders, but we don't expect that in the near term. What we would expect from this one is that we would hope for 2 or 3 good years of returns from the portfolio. And if that happens, what will also tend to happen is that discount will close and we'll get a little bit of extra upside from that. These are 3 very similar LICs, CD1, CD2, and CD3. They invest in US private equity. If you've heard me talk, we've talked about these before. They're all fixed term LICs. Like most private equity funds, they had an initial 2 to 3 year investment period, then a few years hold period, and then they start selling their investments over time. And so CD1 and CD2 are in that kind of what we call the harvest mode now, where they're selling their private equity investments over time. CD3 is a little bit just starting that phase now, perhaps in the next year or so. So there's a few years left, but what we do know is that over time, over the next few years, all 3 of these LICs will sell a good part of their portfolios, perhaps their entire portfolios, and the rewards will all come back to investors. So as they sell these investments, they make distributions back to investors. Now, currently, all 3 are trading at pretty substantial discounts. CD1 and CD2, generally over 30%, 30-35%, CD3 not quite as much. Combined market cap of about 180 million, relatively thinly traded, but these are LICs we have owned to different degrees pretty well over the last 3 or 4 years, and we've done very, very well out of them. And we think going forward, we will continue to do very, very well. So not only ultimately will that discount close to some degree as investments are realized, but ultimately all of the capital will come back, and there's the potential for the underlying private equity investments to go up in value as well. So your net asset value could be increasing as well. So again, more than one way potentially to make money out of CD1, 2, and 3. And finally, Salter Brothers is also, like Ryder, a LIC that's focused at the small cap end of the market. A bit more of a growth-oriented portfolio than Ryder. Ryder is more of a value portfolio. This is more growth. But there's a couple of probably distinguishing factors between the two. Obviously, one is the value versus growth focus. Another one is that the discount's larger for Salter Brothers. So it's currently a discount of around 30% net asset value. And it also has an activist shareholder on the register with a reasonable holding. And so this becomes an interesting play over the next couple of 3 years. What we think will happen is that the portfolio will go reasonably well, and you'll see some good returns. and the discount will start to close. And like Ryder, you'll see hopefully a portfolio return and a bit of extra upside from the discount closing. If that doesn't happen, the fallback is that it's likely that shareholders on the register will start to push much harder for a more permanent solution, perhaps a delisting, a wind up, a conversion to an unlisted fund. And what that would do is permanently close that 30-odd% discount and give shareholders a one-off gain. Now, we don't see that happening in the next 12 months, but if performance doesn't continue to go pretty well from here, we would expect increasing pressure on the manager to do that. So potentially this is a discount capture play, potentially this is a alpha generator, a good performer, and if those things don't happen, it's potentially an event-driven trade where something happens structurally which eliminates the discount. So we like that because it gives us that optionality in returns going forward. So I think that's hopefully helped today give you a bit of an understanding of what we're currently looking at, how we think about the sector, where the potential is at the moment. This is probably one of only a handful of times in the last 8 years where we've looked at it and we've said, look, we've got this situation where the discounts are well above average and the portfolios that these LICs own are pretty good value as well. And each time that's happened in the past, it's tended to be a pretty good starting point for an investment. Now, these conditions have been around for a few months now. We've been talking about this for a little while. So you really got to have, I think, a 2, 3, 4-year view. We suggest a minimum of 3 years and potentially 5 if you want to invest in this fund. You've got to have that medium to long-term view, but we believe it's a pretty good starting point. Just to recap on the key strengths here, obviously, we've got a very specialized strategy in a specialized area of the market where we can have a lot of focus and perhaps have a bit more rigor than the average investor. You're getting access to some really good managers through LICs, and you're also getting access to a lot of diversification. You're getting access to our discount capture strategy, which is another way to add value over and above the LICs themselves. I haven't talked about this, but we're big on alignment of interest at Affluence. So we will obviously co-invest in the fund alongside our investors, but also we only charge performance fees. We don't charge any fixed management fees. And ultimately, this strategy has a limited capacity. We still want to be able to play in that kind of $50 to $500 million market cap. So we'll close the fund to new investors when we get to capacity to allow us to continue to reap the benefits of being in that smaller market cap range. We've managed to give pretty good medium to long-term returns, and we've obviously got that additional feature where we've been able to do that with lower volatility than the ASX 200. And finally, the regular income, the quarterly distributions targeting that 5% is a regular feature that a lot of our investors like. So hopefully that's given you a bit of a snapshot of where we're at. If you are interested, there's heaps more information on our website. The fund itself is unlisted. You can invest and withdraw in the fund monthly. So to come in at the end of a month, you've got to have your application form and your funds in by the last business day of the month. And the investments are effective on the 1st of each month. Similarly, if you're withdrawing from the fund, you've got to put your withdrawal request in by the last business day of the month, and the withdrawals or the redemptions are paid 10 days after the end of the month. I've mentioned the fees, the buy-sell spread. You can also see our key service providers there that help us run the fund. We've worked with most of them for quite some period of time. So we've got a long and established process for running and administering these funds as well. So hopefully that was useful. If you'd like to learn more, as I said, there's plenty more information on our website. You're welcome to get in touch with us directly by phone, by email, whatever's easiest for you. Happy to have a one-on-one and answer your questions. If you're an advisor, you need the research, you'd like to learn more about the platform inclusion, please get in touch and we can help you there. And finally, if you want to keep up to date with what we're doing and you're not currently a subscriber, you can subscribe on our website to get our monthly email, which includes all of our fund reports and also a bunch of other stuff we think is pretty interesting about what's happening in markets and hopefully a few investment ideas as well along the way. Thanks very much for your time today. I've very much appreciated you taking the time to listen, and look forward to catching up again soon. Thank you very much.